Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss about portfolio management. The focus is on contemporary issues and emerging trends. We are going to discuss about program trading, and we say the following, you can write the following, that it refers to volume trading, which is done by systems, executed by systems, usually automated based on an underlying, let me write it properly, apologies for that, underlying based on an underlying program or idea. Let's stop there for 1 second, guys. It refers to volume trading, which is done or executed by systems, usually automated based on underlying program or idea. It is a wide range of portfolio strategies. It is a wide range of portfolio strategies, involving the purchase or sale, of stocks. We can say purchase or sale of 15 or more stocks, 15 or more stocks having a total market value, total market value of $1 million, $1 million or even more. Stop there. It is a wide range of portfolio strategies involving the purchase or sale of 15, ladies and gentlemen, or more stocks having a total market value of $1 million or even more. Now, once we have introduced what program trading is, it can almost be referred to as algorithmic trading, high volume trading that involves the utilization of a given number of strategies, ladies and gentlemen. And we're also saying that the strategies could be, or the types could be either principal, they could be either basis or even contra-day strategies thereon. So we can continue and say that program traders are almost always, traders are almost always program traders are almost always executed by computers. by computers. Although there are instances, we can say although there are instances in program trading, there are instances when this isn't the case. When this is not the case, for example, institution X, institution X wants to sell a basket of 15 stocks. Wants to sell a basket of 15 stocks totaling $2 million. Totaling to $2 million. $2 million. $2 million. It would simply split up. It would simply split up the sale among different brokers. Among different brokers. In other words, you're saying that people plan the strategy and you're saying the computers are the ones that do the work. So traders are almost, I've written R twice, are almost always trades are almost always executed by computers. But although there are instances when this is not the case, for example, institution X wants to sell a basket of 15 stocks totaling $2 million. It would simply split up the sale among different brokers. So when people plan strategies and the computer does the work, this is how program trading looks like. So we have this computer right over here. Please forgive my drawing right over here. And I'm saying that here is where the coding or the codes are actually created. Of course, there has to be what you're calling the CPU right over there like that, and it's the one that actually does or processes or executes trades. Buy and sell. I can put it in a different color over here. Buy and sell. Buy and sell of securities. Buy and sell of securities. Then we are saying the types can be of 3 of them. Types of program trading can be where the principal over here, we are saying this is where replication of an index is actually ensued. So replication of an index, where the portfolio manager or the strategies try to copy the returns that have been generated by an index. And that is all done by the program trading or by the computer. So replication of an index. Then the second type of program trading is basis over here. And over here, trying to identify price inefficiencies, strategy to identify price inefficiencies. So the computer tries to identify price inefficiencies, trying to identify undervalued stocks or tries to identify undervalued stocks. Undervalued stocks is what the computer system actually buys those stocks, of course using an algorithm, and the overvalued stocks are actually sold. Then finally, the third type of program trading is contra trading, buying and selling through buying and selling consistently like that. So we're saying we buy in one market and sell in another market right there. So we're saying that's what happens in a contra. Buying and simultaneously selling the same security. Buying and selling the security simultaneously. So of course this uses futures or options, and that is actually executed using the computer system. So we are saying what? We are saying that the types of program trading include the principal, which involves replication of an index, and that is done by the system, by the computer system or algorithm. Basis trading, which involves a strategy to try and identify pricing inefficiencies, undervalued stocks and overvalued stocks. Then there is contra trading, where you buy and sell securities simultaneously in different markets using futures contracts. Let's move on this other side. Let's look at the advantages. Advantages of program trading. We're saying it is quick to execute and implement. It is quick to execute and implement. Number two, over here we say places trades according to strategy. It places trades according to strategy. Number three, exploits opportunities without emotions. It exploits opportunities without emotions. So it is quick to execute and implement. Execute and implement are the keywords there. Second, it places trades according to strategy, either basis, principal, or contra, actually executed using algorithms. So you can be able to come up with an algorithm that actually executes principal strategies, basis strategies, and even contra strategies. Very simple. It exploits opportunities without emotions. That is very key. So having looked at the advantages, we move over and discuss the disadvantages. Disadvantages. We are saying that number one, it brings about extreme volatility. For example, in the 1990s, it brings about extreme volatility. And for example, in 1990s, there was a bit of a flurry of activity that took place as a result of program trading. Number two, it is expensive. It is costly to implement and trade. It is costly to implement. So these are the two main disadvantages over here, that it brings about extreme volatility, for example, in the 1990s, and it is costly to implement. So this brings us to the end of the lesson. We hope you have enjoyed it, and I will leave you the assignment. The assignment is as follows, right down here. Assignment. Explain what is meant by program trading. Explain what is meant by program trading. So thank you for being with Manifested Publishers. Continue being with us, and we are here for you.